Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to be ripping into Twitter, see what's going on, seeing what's being shared on FinTwit, so to speak. It's going to be commodity related, it's going to be financial related, and obviously I'm going to interject my opinions. Whether you agree or disagree, well, that's up to you, and it's fine to disagree with me. I'm going to hold my opinions. I can give you the reasoning behind them. And hopefully I'm giving you a little bit different opinion than we'll call it all the chatter on YouTube. That's just one big echo chamber that people are basically echoing. And hopefully I'm the voice of truth, at least the truth that I see in the markets. So let's dive in. Let's take a look and see what's going on. Again, if you want to follow me at finding_finance, and if you want to join our community, it's finding-value.com. Use the word discount in the coupon code. We do have a 7 a.m. Mountain Standard Time Saturday question and answer session that you can ask me directly. So coming on down, Mike, whatever. I got this. Someone sent me this in my inbox. It says, manufacturing and housing conditions are starting to improve, which could stall a recession. Look at the charts here. So we've got real GDP starting to kick back up, maybe. We've got PMI manufacturing index kicking up. Potential bottom, I don't know. I'm not claiming that it's a bottom, but maybe it is. And then we've got home builder housing market index in terms of confidence, which is bottoming and starting to turn up. That is for the home builder housing market index and the existing one-family home sales. So maybe it's bottoming, maybe it's improving. Again, I don't know these factors in the short term. Things are going to cycle back and forth based on many variables in the market. It's going to be interest rates. It's going to be which impacts the affordability. It doesn't mean that home prices are going to crash. Doesn't mean that home prices are going to go straight up. What it means is that the market is going to digest information, it's going to digest interest rates and affordability, and it takes a little bit of time. And markets will adjust, move, but I don't think there's going to be this underlying big old market crash in the housing market. The reason I think that is because we are underbuilt for the family formations in the world here. Or in the United States, I should say. I didn't say the world, but in the United States. We are short 3 to 7 million homes, depending on which data you use. A lot of people, I would say, are around the 3 to 4 million mark of underbuilt homes in the United States. We have not built those homes. So that means that the pressure of home buying is in the system for a period of time. And if that pressure ceases to exist, what we would see is we would see an overbuilt scenario where we would go into a hypersupply phase. And that is by definition of the end of this cycle. And we have inventories that are incredibly low, and therefore, by definition, we are not in a hypersupply phase because we have no supply. That is my opinion. So the pressure is going to remain higher for house prices, or to remain at high, elevated, unaffordable levels for a period of time. I'll put it that way. Keith Weiner says, and I think some people wanted me to talk about this because they forwarded it to me, says, if the Fed is printing money, and if printing money causes inflation, and if the Fed has done quite a lot of money printing, hence caused quite a lot of inflation, why is copper cheaper than it was over a decade ago? Well, I can explain that. That is the cycle. And the cycle is what causes money to rotate from one asset class to another. The conditions are what reveal the money that's in the system. And that money needs to flow into assets that will recognize that that money has been created in the system. So under a low inflation, low interest rate environment, money is going to go to financial stocks and bonds, financial assets. When that money sees inflation, because the market conditions are changing. The money is going to rotate into commodities, which will then be accounted for in inflation. And this is going to happen. It doesn't happen immediately. It doesn't happen quickly. And it's going to rotate over the next decade. Money is going to flow where the shortages exist in the system or where the problems exist. The greatest problems and the best solutions for those greatest problems is where the money will be made the most. And that happens anywhere in a free market. So if traveling is the biggest problem or the biggest want, and the best solution is electric vehicles, then money will flow towards electric vehicles. Money will flow towards airplanes. Money will flow towards the things that people want, desire, and need in a society to those of the best solutions available. So this one says, which one is more screwed, housing or NVIDIA? The majority of people say that housing is more screwed than NVIDIA. I would disagree with that. I think NVIDIA is going to have a more strong of a headwind than housing. Housing has the demographic at its back in terms of population. It has low inventory. Pretty easy to see that housing is stable, and I think it is going to remain stable. NVIDIA is going to be very rocky, I think, and being in the technology sector, we could see volatility. Now, I could be wrong. I know NVIDIA is tied in with artificial intelligence, and we'll have to see how well artificial intelligence does. But NVIDIA very well could be the next mega bubble stock. And it already has been to some degree. Here is the latest comparative inventory of 524. This is for oil. So the total commercial petroleum stocks are down 11 million barrels of oil equivalent. Wow. Calculated WTI fair value price of $78 a barrel. It's $4 undervalued from current levels. Any quarter two total stocks draw would be bullish compared to historical standards. So this is what we've got. We're at the blue dot here. This is a scatter plot all on a graph. What this is looking for is you're looking at the total petroleum stocks, and then you're looking at the price of those. And depending on where those stocks are, we can calculate if it's undervalued or overvalued based off of historical data. So what he did is he took a scatter plot, plotted it, and then basically put these lines as the average, so to speak, and then some sort of statistical significance level to move away from it, whatever the sigma is there. And what we're seeing is that we're within the normal range. We're not out here where we're really low and undervalued, but we're just slightly undervalued at this time. And if we expect large draws in inventory, what that's going to do is draw us down either to undervalued territory, where we're going to have to come back up and meet it in price. So price is over here, valuations here. If we eat through our inventory levels, we should be moving up in price like that. If you notice, low inventory levels are correlated to high prices. I have a feeling that our inventory levels could potentially really get drawn down at some point. That's with our current drawdowns that we're seeing and the cutbacks that OPEC has done, which will materialize in June. Here's Logan. He says, how has inventory grown post-2010 for the existing home sales market? Weakness in demand, days on the market growth, and inventory accumulation. 2014 and 2022 are examples. The 2000-2008 inventory channel market model doesn't work for the last 10 years because credit channels are different. It says, after the most significant home sales collapse recorded in U.S. history in 2022 and stabilization in sales data in 2023, total active listing NAR stands at 1.04 million. It's up from 1.03 million. The historical norm is between 2 and 2.5 million. In 2007, just for context, we were a tad above 4 million. This is your total inventory data going back to 1982. Look where we stand today in relationship to history. What this is telling us is that we have no inventory of existing homes, and it is lower than any time in history going back to 1982. We cannot be in a bubble and have our inventory be bare. That is like saying if you go in a grocery store and there's no food in the grocery store, and you walk out and you say, you know what, we're in a bubble. We have so much food in there that no one can buy anything because it's gone. Guys, it doesn't make any sense. Bubble and low inventory cannot go together. They're incongruent. Now, could a bubble be forming and inventory be added? Yes, but one cannot make that conclusion at this time. You could say house prices have fallen, and there's something different about this particular time. It's an anomaly where home prices have fallen and inventories are low. Why is that? Well, we could be seeing something different in the markets that we haven't seen before. Maybe it was the interest rate increase, the speed of it, and the markets need to adjust. I don't know all the answers, but I can tell you having no inventory of homes is incongruent with a bubble. And anyone who's claiming that we are in a bubble and that we need to look at data to see that if you just look at the baby boomers, and if you just look and see how many people could potentially die, and if you just looked at the millennials, and if you just looked at per capita houses per person, guys, that doesn't matter. That does not matter. That's like saying, look at how many females are in America, and look at how many males are in America. There are no shortages of females for males. And then you look around and you say, well, how come 50 or 40% of males are still virgins that are age 30? And everybody's scratching their head. But there's so many females in relationship to so many males, and they could be mating. Guys, it doesn't work like that. Your inventory level is your data. That is the final say. That's like saying, if I studied, I could have got an A, but you got an F on the test. It's just excuses, guys. This is your final call. This is what determines prices to some extent. Now, it doesn't mean it's everything, but I'm just saying it determines things. If you've got a millionaire that's multi-billionaire or millionaire that owns 10 homes and they're $5 or $6 million each, do you think the average person's going to buy that house? No. Then what the heck does it matter? What's it matter if 2% of the males sleep with 80% of the females? Those bottom 30 or 40% doesn't matter. So there are things that I think you can't just start throwing data out and say, what if, what could, there's more home. It doesn't work like that, guys. It's the inventory level that matters. And this inventory level, if I scratched out all this and all you looked at the data and you said, this is the inventory level of any commodity, of anything, what would you conclude of the pricing of this commodity if it was at the lowest spot all the way back to 1980? You'd say, well, it's probably priced very high, and it's probably the least affordable it should ever be in history. And what do we have today? It's the least affordable in history, and we've got the lowest inventory level there is. The question now is, does inventory increase or not? And if inventory increases, prices will remain resilient for years to come, for a year or two. So don't worry, just wait for the inventory to come. And then make your conclusion and call the housing bubble when the inventory starts increasing. If it does, we don't know what that necessarily will look like. We don't know the dynamics between baby boomers dying and millennial home buying and the pressure that's coming. That intersects at inventory. One cannot conclude. One person cannot conclude, or any amount of people cannot conclude that we are in a housing bubble based off inventory, and that a fictitious number of people are going to die that haven't died yet, that could die 10 years from now, or 5 years from now, or 2 years from now, or 20 years from now, that is for surely going to impact the inventory levels with 100% confidence. What I'm going to say is throw that out the window. Say, yes, I understand that a smaller demographic called the baby boomers, then the millennials, and an underbuilt scenario of 6 million, 4 million homes or whatever it is putting pressure on housing prices. And all of the data that we have today currently is supporting that viewpoint. The affordability is at the most unaffordable level, or one of the most unaffordable levels, maybe not the most. 1982 was more unaffordable, but we're at a very unaffordable level. We are at very low inventory levels, and that is supportive of a market that is tight. That's what I'll say. And you got to like my analogies, guys. Oops. You got to like my analogies. Here is crude oil versus natural gas. All right. What is this big head and shoulders in the making currently having on this ratio chart? What's going to happen here potentially is that oil will outperform natural gas in the short term, and then natural gas is going to turn and kick butt. And I don't know exactly when that time frame will be, but it looks pretty dang close, maybe a couple months out, and natural gas is going to hit it again maybe this fall, winter. So natural gas is definitely one I would be looking at, but that's me. Cheap ratio, nice looking charts. This is a topping pattern that's definitely going to work its way lower in my opinion, and it's very cheap. I like Eric here in his quote. Things are so terrible that we just had the largest weekly inventory draw in U.S. oil, gasoline distillates since August 2020. It's correct. Here's another one. This is on copper. Copper's been selling off here recently. He says the fractal here is stunning in my opinion. If it's to repeat, this is where copper bounces and runs to $5, $5.50. So this is the same fractal here, same fractal as this. We come back down. He's thinking maybe the green arrow is where the green arrow is, and we have a nice big run up in copper. Very well could be the case. I know inventories of copper are very low. A lot of people are very bearish on the economy at this point, and maybe that will turn around and change. But something to keep in mind, nice little fractal chart there. Good work, Casper. U.S. implied oil demand on a 4-week basis surpassed 2019 last week. It says 4-week average U.S. product supplied of petroleum products. And look at where we are. We're actually higher than any time in history on this chart, the past 5 years. So it's going to be interesting to see the 4-week average of U.S. products supplied for petroleum products moving up into potentially all-time highs. This is Grady. He says 23rd of May yesterday, and platinum is still holding its mega blue backtest on a monthly. And it does have a higher high after the breakout, which is trend change confirmation. So we've got a breakout, a backtest, and it's still holding it for platinum. And now we can see if we can get a big run up here. So be patient, guys. It's coming. Energy burrito. Look at that. 12.5 million deficit or inventory draw. So here's a summary of the Fed meeting minutes, just to let you guys know what's going on there. Fed sees uncertainty over further rate hikes. Debt default threatens tighter financial conditions. Fed sees mild recession in late 2023. Inflation is still unacceptably high. And 5, additional policy firming may be appropriate. The Fed's next moves are highly uncertain. Now here's something, right? Yield curve inversion, recession warning. Yield curve steepening from inverted levels equals recession starting to get priced in. So they have, or what he's saying is the 10 and 2 year, and this is going to come back up and it's going to get priced in. So a inverted yield curve doesn't predict a recession. An inverted yield curve is part of the cycle. The yield curve inverts when you get inflation. And this is where things get interesting. All right. What caused this inversion of the yield curve? What is the cause of it? Is it the stimulus money or is it the housing market? What caused this inversion here was the housing market coming into an expansionary phase going into an oversupply phase and then the crash of that housing market. This one here was driven by other things in the market, which was the NASDAQ bubble. And this here, I think, was another housing crash move. Here, I don't think it's going to be caused by the housing crash, but we very well could have a recession. I'm not stating that we can't. I just think it's going to be similar to 2000, 2001 in that time frame. We are also in alignment with commodities in the same time frame as 2000, 2001. So we could have a pullback here where we do have a recession. There's also the possibility that we stay down here and actually invert further to the downside or go sideways for a little bit, kind of like it bounces around here for a year or two. That's also a possibility. I don't know what the eventual outcome will be, but I do look at how strong the housing market is, and that could delay a potential recession. And the reason it can delay the potential recession is because a lot of people are employed in that construction cycle. And we have not built the homes that are needed and wanted in society yet to the degree that we go into a hypersupply phase. So that's part of that cycle. Happy Wine says, at some point, Treasury yields spike while the DXY plunges. And that's when the Fed does massive monetization and yield curve control. Gold and silver reprice multiples higher, many multiples in the case of silver. I agree with this. I do think if interest rates get too high, that they're going to have to do some sort of yield curve control. And that is also when I think the DXY plunges. I think he's pretty much spot on there. Now here's one. He says, every time I listen to one of these macro doomer podcasts like Luke Roman, I find the logic incredibly persuasive, and I agree with the majority of what they say, but I never end up making any money at the end of it. Is this a common experience? And I think that is true for a lot of people that listen to YouTube finance channels. I used to listen to YouTube finance channels for a long time, and a lot of them, like, I don't want to name names. A lot of them make all these claims, and a lot of the claims will never come true. It's a lot of predictions that they were making. I think what I was missing was a strategy and a thesis. And you can debate where we are in my thesis that I created, which is based off the real estate cycle and strategies of investments around that real estate cycle. And people are debating where we are in that cycle. What I'm trying to do is try my best to identify where we are in that cycle, stay long in the things that will benefit depending on where we are in that cycle, and then sell when the pressures cease to exist in that cycle, which is driven by the demographics and population and the real estate market. The Van RE buyer roller coaster. I should buy a home. Starts looking. Market rips. This is crazy. I'll wait until it calms down. The market slows down. It's going to crash. I better wait. Market rips again. Oh, crap. Now the market's softening again. Your move. It says this clear ratio chart decides whether silver will take the lead in the precious metals bull market or if it will be platinum. So break down below the yellow line. That's platinum outperforming silver. Conversely, if this breaks higher, it's going to be silver outperforming platinum. I think during certain periods of time, we are going to see these metals vastly outperform each other depending on the market conditions. Inflationary and the housing market boom is going to be platinum. If it's a fear-driven event, it will be silver. That's my guess. Here's palladium. He's making a statement. Palladium's a precious metal which tracks U.S. stocks. I have said that the whole time for years. Palladium does track the overall market. It is our sole investment that we use that is counter to platinum, silver, and gold. So palladium is great when you have a low interest rate, low inflation environment. High inflation, platinum is where you want to be. So palladium's good for this. Following the markets, and you can see it's broken down to the downside. That's why I do not own any palladium and why I swapped all my palladium for platinum. And then eventually, when the time comes, I may swap all my platinum for, it's probably going to be silver, and then silver is going to run towards the fear portion of the crash. And then I'm going to swap my silver for palladium at some point. And then we ride it through the cycle again. Here's Eric. He posted, wow, that's a big draw. You can see this big move to the downside for the big three drawing down. This is U.S. crude oil inventories excluding the SPR, and you can see we are starting to get below the 4-year average, just to show you from a graphical representation of oil. Here's one. It says 62% of Americans live paycheck to paycheck. 50% of Americans earning over $100K per year are living paycheck to paycheck. Is this an income problem or a spending problem? I am going to say it may not be a spending problem if you make over $100K and are living paycheck to paycheck. I don't know everyone's circumstances, but I could see someone making a little bit over 100 grand where things get tight because you have kids and they eat a lot. They can get hurt, which means you could have medical bills that they've got. There are things in life where a person could live paycheck to paycheck for a good portion of their life and earn over $100,000 a year. So I don't, I know a lot of people that are young that make these claims, but they just haven't lived life yet. They haven't experienced problems or issues, and hopefully you don't have to experience those problems or issues. But there are times in people's lives where money gets tight, even though you might make a lot, because of circumstances that may be out of your control. It could be an accident that occurs or something that happens, even though you might make that amount. You may be living paycheck to paycheck for a while. It says, quick, what are the top 3 reasons you're in commodities? Undervalued, market conditions, technical analysis. Boom, the 3 pillars. So that's what I've got for today, guys. We'll end it there. We're getting kind of long here. So those are my opinions on the markets at this time. I can obviously change my opinions if the data changes. I will change in a heartbeat if I see that happen. But right now, those are my current opinions. And again, if you guys like this content, give me a thumbs up, subscribe to the channel, subscribe to the website if you'd like, and we'll catch you guys later. This is Finding Value.